Hi everyone, thanks for tuning to my channel, All Things Accounting. Today what we will be discussing are profitability analysis. So we'll go through some ratios and I'll deconstruct what they are and I'll go through an explanation of the finer details of it. So stay right there and we'll get through this together. So profitability, when businesses operate, everyone's hope, especially the upper management, is that the company will be profitable. So what does that entail? It entails a lot of work, obviously, but let's go through what we mean by profitability. So profitability indicates how well management is using resources at its disposal to earn a return on funds invested by various groups. So investors won't just hand over money for free. They want something in return, and they will pay very close attention to how management is running and directing the course of the business and how they're doing, so that they know exactly how financially healthy the particular company is. So when we look at this, there are certain indicators that we can look and use in order to help us determine how profitable a company is. So let's look at something that's called a return on assets ratio. So this is computed as net income plus interest expense net of tax all over average total assets. All right, so here the interest expense net of tax, we add that back because we know that net income is on a net of tax basis. Okay, so this is a measure of a company's success in earning a return for all providers of capital, and it's a very useful tool. Our next ratio is called earnings per share. Now this is a very popular ratio that is used. It's a company's bottom line stated on a per share basis, and it's calculated as net income less preferred dividends divided by weighted average. So I'll just designate weighted average as that. So weighted average number of common shares outstanding. So net income minus preferred dividends all over weighted average number of common shares outstanding. So this is one of the most widely quoted statistics for publicly traded companies, and it allows shareholders to relate earnings to what they paid for a share to the current price of a share. Our last ratio that I'll just be going through today is called the price earnings ratio, or price earnings ratio. Okay, so this is the relationship between a company's performance according to the income statement and the performance in the stock market. So this price earnings ratio here, it's computed as current market price all over earnings per share. Now, the stock market's the current market price is the stock market's current assessment of the company. So, what is a good price earnings ratio, one may ask? Well, it's like other ratios. It depends. It depends on the nature of the industry that the company's in, the history of the company. Now, it should be used in conjunction with good understanding of both the underlying business and the nature of the industry. So for example, if company A uses a double declining balance method for depreciation and company B uses straight line, for example, then company A's earnings per share would be more conservative than company B, because if it had used straight line, it would have reported a higher earnings per share. So I hope this tutorial helps you out a bit. I know it's just 3 ratios that I've analyzed, but there are more of the more popular type of profitability analysis ratios that are widely used. So if you enjoyed this tutorial, please subscribe to my channel, hit that like button, and click that bell notification icon so that you're always up to date on my new tutorials that I'll be posting. So until the next time, stay safe.